My goal is not to fail fast. My goal is to succeed over the long run. They're not the same thing. Man, I love this book. And you know why I love it? Because it's full of value. I learned so much from that book. And when I'm gonna be done reading it, I'm just gonna throw it away like this. I'm gonna keep it in my shelf and go back from time to time for pieces of wisdom. And you know what? This is exactly what so many investors do wrong. When they pick a winning stock, they get rid of it the moment they start making money. Following up to last week's video about losing money on a stock, should you sell or hold? Today we're looking at, I'm making money with a stock, should I sell or should I hold?
Dividend investors, bonjour, this is Mike Yaru from Dividend, Stocks, Rocks, and Passionate Investor. Today I'm outside, my office is right there, and I felt like, you know what, let's do something special because we're talking about special stocks. We're talking about your winning guys, those that have been to the war, fought back, and actually made money for you. So let me ask you a question. Why in the world would you sell those stocks? I mean, whenever you're making money, just keep them. You know, when I started investing, like it was, I don't know, 18 years ago now, and I was fascinated how guys, just like you and me, put 100K in the stock market and then follow-ups a few years later showing portfolios value of 7, 8, 900, $1 million portfolio value. And they made all of this possible with the beauty of the power of compounding interest, dividend growth investing, keeping their stocks forever. I mean, when you think about it, when I look at my portfolio, I'm making mistakes. I'm sure you did too. And you know, those companies are dragging down my portfolio a little bit. But what brings the overall total interesting, what brings the value up, are my winners. But not those who are showing like 20 or 30% increase. I'm talking about the big guys, the triple digit big guys. I'm talking about stocks like Apple, Union Pacific, Disney, Johnson & Johnson, Lockheed Martin. All those companies in my portfolio shows over 100% return. This means that they have more than double in value. And you know how I did that? Not because I'm a genius, not because I found a magical recipe, only because I kept my winners. So my rule number one when it comes down to whether or not I should sell my winning stocks is I just keep it. I just keep my winning stocks. And you know why? Because I spent so many hours trying to figure out which company to buy, looking at fundamentals, reading financial analysis, going deep down into quarterly earnings, and then finally writing down my investment thesis, figuring out why in the world should I put my money in that stock. And then I realize I'm right. And I know sometimes you're gonna feel that you're up like 40 or 50%, the market is overvalued, we're on the verge on a bear market of a crash, and you're just thinking, oh, let's cash this investment. Let's keep that money in my pocket so I can secure my profit, right? This is what you're thinking. But it's all wrong. That is a loser attitude. The winning attitude is, you know what? This company is strong. My investment thesis is strong. They are a growth vector. And in the future, this company is going to bring a lot more dough in my portfolio. So if the investment thesis is still right, the dividend is still growing, why would you give up that such beautiful hidden gem that you found? So according to the financial market theory, it's impossible to beat the market. I mean, dividend growth investors do it all the time, right? But I mean, between others, they do not beat the market. So if you found that incredible company, just keep it. You know, it is so hard to find a company that is somewhat undervalued for some reason that if you found it, just keep it. Just keep it and ride it all along. And now, sometimes, only sometimes, you will have to sell your winning stocks. And this could happen in two different situations. So in number one, Imagine that you just bought Apple 15 years ago and now it's 25% of your portfolio value. So one company is basically holding your portfolio like this. And if anything happens to Apple, or that company worth like 24, 25, 30% of your portfolio, and it crashes down by 10%, your whole portfolio is at risk. So I made that kind of like special rules to myself, and I used Apple as an example because this is one of my largest holding. But whenever Apple will reach over 15% of my portfolio, I will not feel comfortable with that, and I will start selling a few shares. Not the entire position, but just a few shares to keep it at 15%. And throughout my entire career as a financial planner, I've seen a lot of clients, because they used to work at a place, because they inherited or because they just got it in their pension plan, they had those huge chunk of stocks in one concentrated company. And they were just like, oh my God, it's a good company, it's making money, I don't want to get rid of it. And I'm like, yeah, well, if it's like a quarter of your portfolio or a third of your portfolio, if anything happens, remember G, if anything happens, well then you're in the deep. So just keep like 10-15%. That would be probably like a good gauge. Like, just understand how much you would feel comfortable with losing like 10 or 15% of or 20% of that value coming from that stock. So that would be number one. Number two would be if your investment thesis is not good anymore. Remember, I keep telling you about the dividend triangle, about revenue growth, earning growth, dividend growth, and you know why? Those things are super important, but you need to follow up on a quarterly basis. You need to make sure that the company is doing the right things and that they're going towards the right direction, the direction that you think that will bring more value to your pocket, to your portfolio. And whenever it doesn't happen, whenever the company is like shaky at one point or not making moves that you like, making an acquisition or just doing something that doesn't make sense for you anymore, well then you have to get rid of it. And it's unfortunate, but you'll have to cash your profit. But not because it's up 50%, not because it's up like 100%, just because it's not showing the quality of the company that you bought in the first place. That is the most important thing. It's not about value. It's not about price. It's about if the company is going to bring more in the future or less. All right, so let's wrap up this video with my number one rule. Stay invested in those winning stocks. You have to be patient when you're losing money on a stock, but you have to be even more patient when you're making some, because this company is proving you right. It shows growth vector, it shows dividend increase, it shows stock value appreciation. So basically it's helping you reaching your goal. Why would you get rid of it? This is your buddy in your investing journey. You want to keep it pretty much forever, unless that stock grows too fat and now it's 15, 20, 25% of your portfolio. You want to bring it down. Now it's up to you to decide. Do you want to keep it up to 10% or 15 or 20? That depends on your risk tolerance and how you want to ride the market, right? Personally, 15% is my golden rule. And then number two, if the company doesn't meet your investment thesis anymore, or slowing down its dividend growth, or forget to increase its dividend payment for the past 12 months, well then maybe it's time to get rid of it and go back to your replacement list and make something interesting. Now, I just hope that you're gonna keep your winning stocks after 15, after 20, after 50, after 100% return. I want to make sure that you keep those winners in your portfolio. So don't forget to subscribe to my channel, and until then, stay invested.